Thanks everyone for coming. Matthew Siegel with Van Eck, run our digital assets research and manage one of our liquid token funds. We're broadly invested across the space, everywhere from venture to Bitcoin and trying to bring a Bitcoin spot ETF to market to trying to find this long tail of tokens and which of them are going to generate true economic returns. But the point here is to introduce someone who I think is an innovator in the space and someone whose story is really emblematic of what's going on with both crypto and banking, right? So Caitlin, comes as a plain-spoken Wyoming native who's found herself in the Washington, D.C. morass. And it really is a morass because there's two different challenges that you're trying to do here. And one of them is to start a bank, which is no small feat in and of itself. And we're going to talk about some of the preferential treatment that's going on where an American-founded company is getting disadvantaged versus foreign-connected firms that also aren't banks. And then the other challenge of getting banks able to hold customers' crypto without taking huge capital charges against those holdings. So it's a tall task, Caitlin. Why don't you start with just the backstory of what has happened so far with the founding of Custodia?
Well, I'll start by saying my whole career I've been a change agent and taken on really gnarly projects, and this is the gnarliest of them all. We didn't go into it expecting it to be this gnarly. Of course, the FTX, all the just fraud and grift and highly leveraged business models that collapsed created a especially challenging environment for those of us, and I would put your company as part of that, who are trying to do everything right and trying to do it up the middle of the fairway and ask for permission for the things we're doing. And there's some sense that the best actors have been the ones who have been the target of the ire of the regulators, right? I'm thinking of Coinbase from the SEC, literally begging to become registered and then get sued for not being registered, and the same thing for Custodia on the banking side with the Fed. But I came from Wall Street. In fact, I've run into a number of folks who I knew 10 years ago and just reconnected here. So grew up in Wyoming, went back to Wyoming. One of the things that we needed to do in the United States was create a legal and regulatory regime to recognize this asset class, and some of the basic things that needed to get done were defining it as property and defining it under commercial law, some of the boring foundational things that we all rely upon every day, but very few people think about. And the state of Wyoming was the first to do that, and that was one of the things that I could help my native state do. And then we moved back from New York to Wyoming in 2019. We were trying to solve the banking problem for this industry because this industry got caught up in the first Operation Choke Point, which was an Obama administration effort led by someone who's in the news very much these days, Marty Grunberg, who's the head of the FDIC, and he's back at the head of the FDIC, and here we have Operation Choke Point 2.0. It's much further than the FDIC. But Wyoming was trying to solve this very problem, which is that the banks were en masse closing bank accounts of valid entrepreneurs in 2017, and those entrepreneurs lost their business because in the United States, if you don't have a bank account, you're not a business. And the reason is that you have to remit your withholding taxes to the IRS electronically via a bank account. So this is a real problem, and we set about to fix it. And at Custodia, we're trying to build an industry utility that is not going to drop this industry.
So most folks think of Bitcoin as the anti-bank. You're able to hold your own assets, and there's no institution that's taking your deposit and then levering it and making loans that put your deposits at risk, right? So what do you see as the role of a crypto-native bank like Custodia? Is it merely to hold the assets and lend dollars to the U.S. government via T-bills, or is it going to be a loan-making institution?
It's a non-loan-making institution, and that sounded radical, but if you look at what happened in the UK last week, the UK came out and pronounced that all stablecoin issuers must be banks that hold their reserves at the central bank and cannot lend them. So while the Fed deemed that business model in January to be unsafe and unsound, which I find rather ironic, the central bankers in the UK said that's what you actually have to do. And it actually, from a risk perspective, is the only thing that makes sense. I was privately warning the bank regulators that Silvergate and Signature were going to have bank runs a year ago. And it was obvious to me why. Because back then I thought it was the potential failure of a protocol that could trigger a run on the stablecoin reserves. But Silvergate had 10 cents of cash for every dollar of demand deposits. Okay, so when the bank run hit, it was forced to liquidate assets at a loss. And the same thing, of course, was true of, directionally true of Signature. So when you think about the transactions that settle as fast as they do with digital assets, and by the way, the same problem applies to FedNow, right? It's really tough to do a traditional lending, maturity transformation banking business when payments can settle that fast, and when a bank run, it used to be that the worst scenario that the bank regulators would have bankers run through in their stress testing was a 2-week bank run. But we saw Silicon Valley Bank essentially fail in 2 days.
So you mentioned that the business model was declared unsafe and unsound. The business model of taking customer deposits and putting them only into T-bills and not making loans, right?
Oh, it's even safer than that. It was taking customer deposits and holding them at the Fed itself. So and there's a difference. T-bills settle trade date plus 1 day. So there's a 1-day liquidity gap. Whereas the Fed has capabilities to do real-time master account monitoring and to prevent an overdraft in a master account. And so that is absolutely the safest way. And I'm not surprised that the Bank of England concluded that. They want stablecoin issuers, which could literally, I mean, Terra Luna failed in 4 hours. Okay, you've got to be able to survive all scenarios of bank runs intraday, and the only way to do that is holding cash at the central bank. It's not owning T-bills or short-term government securities, and that's exactly what the Bank of England just concluded.
Right, but we've concluded differently, and if I'm not mistaken, there was the former head of research at the New York Fed tried to start a bank called the Narrow Bank, TNI, which was kind of, as I understand it, a very similar business model to Custodia in terms of the fiat side of the business, and they were also rejected. So just what would have to change in this country to enable this type of business model? Yeah,
the Narrow Bank was a very different business model. It was not crypto at all, and they were trying to arbitrage monetary policy. So that was different, and the Fed has since promulgated rules that were not enacted, but Wyoming actually prevents banks from that business model trying to arbitrage monetary policy. They were basically going to threaten the way that the money market fund industry was operating, which is why the Fed had such a reaction. In our case, it's very different. Our case wasn't going to threaten anything. But here's the interesting thing. A lot of folks think that our litigation, which I won't go into other than just to talk about the impetus of it, a lot of folks think that it's a crypto case. And in some ways it is, because it was caught up in Operation Choke Point 2.0 very clearly. There was a coordinated effort by the White House, the Board of Governors, and the Kansas City Fed, all of which released statements in the case of the White House and the Board of Governors at the same time, denying Custodia, and then the Kansas City Fed came over the top with military precision exactly 2.5 hours later on the hour to deny our master account. And then the next day, Dick Durbin attacked us on the Senate floor, right? And I have never met Dick Durbin. I've never met anyone at the White House who was involved here. And we had insiders coming forward telling us what was really going on. It's just a crazy story. So how do you fix that? I mean, ultimately, one of the interesting things about what's happening in U.S. digital asset regulation is that it's ending up in the courts. And Custodia did file suit. What's fascinating, though, as I said, there's a perception that this is a crypto case, but in fact, actually, it's a states' rights case as well, because if you look at the Fed's database of who has master accounts at the Fed, there are 442 institutions that don't have FDIC insurance or insurance of any kind federally and don't have a federal regulator, okay? And so the Fed promulgated guidelines. This is all public. that said, well, there are three types of banks. Tier 1 is insured, Tier 2 is federally regulated, Tier 3 is all the states that don't have insurance. We try to get FDIC insurance, but the point is the states are disadvantaged. This country has a dual banking system where state banks and federally chartered banks are equal. But the Fed just created in its guidelines a special category to push down the states. And there are multiple banks that have nothing to do with crypto that have also either been denied or delayed. There are 6 US states that will provide bank charters to fintechs that couldn't get FDIC insurance but become banks. Now, we were talking in the green room, why would a bank want to do that? Why would a fintech want to become a bank instead of just a licensed money transmitter? One of the answers is a bank is a qualified custodian under the SEC rules. There are many other reasons why a fintech would want to become a bank. But the point is there are 6 different states. Interestingly, 3 red states, 3 blue states. So this isn't a political thing. And 4 of them have chartered uninsured banks, none of which have been granted Fed master accounts. Lots of different business models. There's one that's an export-import payment company that has an API that as soon as a goods clear customs, the payment invoice gets generated and the payment goes faster. These are interesting business models having nothing to do with crypto, but they are also being either delayed or denied unlawfully. And the law that is at stake here, for those of you who are historians of the Fed or monetary historians, it was a law called the Monetary Control Act of 1980. And Volcker begged Congress for it the last time we had high inflation. And the reason is that most of the banks were outside of the Fed system back then. And back then, there really wasn't much credit creation happening in the securities markets. It was mostly in the traditional banking system. So long story short, if you've studied economics, you know that $1 of monetary base got multiplied into $10 of M2. Think about MV equals PQ. This might be bringing back some memories from your economics class. And the point is that was the mechanism of credit creation, and most of that credit creation was outside of the Fed's reach, and that was part of the reason why Volcker was having trouble slaying the inflation dragon. And so he begged Congress to require all depository institutions to be treated equally and to come inside the Fed system, and that is what the statute says. The statute says that the Federal Reserve shall provide services, to all depository institutions on a non-discriminatory basis. But what did the Fed just do? It started discriminating against the states.
Yeah, and we can't overemphasize what an impact this set of policies has had on fundraisers, like fund managers like Van Eck, who are forced as a New York regulated, SEC regulated institution. We have to do business with only the qualified custodians now, and that universe shrunk to basically 3 players,
right,
at least as our lawyers explained it to us, and it's kept a lot of institutions on the sidelines. So we're very hopeful that the situation may change, and notice that Custodia just announced a new Bitcoin custody product. Maybe you can introduce that for us briefly.
Yes, I'll leave it factual because we are not yet licensed in New York, so I cannot solicit business in New York. But we did announce our Bitcoin custody. It went live in October. We custom built that platform, very different than some of the players that got up and running faster, that were piecing together some of the infrastructure players that are very commonly used in this industry. But we've seen, for example, in the Fortress Trust case, some of those integrations are not always secure. And so it's much better, and especially when you're building to bank standards, we believed it's much better to build our own custom platform, which is exactly what we did. We also offer something different, which is not an omnibus account. It's a segregated account. And the impact of that is it's designed for fiduciaries. We were talking in the green room a little bit about these omnibus account structures. When we've seen the failures of like Prime Trust in Nevada or for example, the Celsius bankruptcy, even though they weren't a trust company, they were deemed to have created effectively a trust for their custody customers, and those Bitcoins were deemed to be owned by the customers. However, because they were all together in an omnibus structure with a bunch of other businesses, Those other businesses created what's called preferences in bankruptcy. And the punchline is that the customers, the custody customers of Celsius, when Celsius went bust, agreed to take 72.5 cents on the dollar. Even though the judge deemed those Bitcoins to belong to the custody customers, they took a huge haircut just to get their money out, because otherwise they had to wait until all the preferences got cleared. So one of the things that's new and different about a bank being a qualified custodian is that banks cannot be debtors in bankruptcy. And the impact of that is that there's much clearer segregation of customer assets in a custodian that is a bank, whereas a trust company can be a debtor in bankruptcy.
Just a couple of weeks ago, the GAO ruled that the SAB 121, which is an accounting rule that forces public companies and banks to count customers' crypto holdings on their balance sheets as assets and liabilities, and clearly would raise the cost of capital for someone who wants to hold crypto on behalf of their clients. We saw Bank of America and State Street essentially abandon their crypto custody endeavors when that rule was initially passed. Do you think that's going to be a catalyst to get banks in here more aggressively, and how long might that take? Well,
Congress is going to have to overturn it. So Senator Lummis from my state is working on overturning it. It's interesting because this is one of the things that came out after the 2008 financial crisis, this whole concept of the public company PCOAB accounting standards that are different than US GAAP. That's a big problem anyway, but what's interesting is that technically that rule only applies to public companies. I was just looking at Anchorage's filings. They're not a public company, and they are not accounting for their custody assets on balance sheet. And so we're an audited firm. We're coming up into the year-end audit. We've been audited for 2 years, even though we just launched in July. But that's one of the questions that comes up with the auditors is, are they required to apply the PCOAB standards, even though we're not an SEC filer, and a lot of others are not SEC filers either. And so it's interesting. I think the SEC, this is one of the many overreaches as part of the Operation Choke Point 2.0, and the SEC clearly got slapped down by the GAO, but the SEC came out and said it's still in force because the SEC was given the authority to basically rewrite the accounting rules with no public accountability, and that's what they did. I think that has to get fixed generally.
Okay, we're out of time. If you're in this industry, you should be rooting for Custodia to succeed. So round of applause for Caitlin.
Thank you. Thanks very much.